Definition of account. An account is a system used to record and classify financial transactions in accounting. Each account represents a specific category of transactions conducted by a company. Accounts are used to track cash flow and determine the company's financial position at a specific point in time. In accounting, every account typically consists of two sides, the debit side and the credit side. 5 types of accounts. In accounting, there are 5 main types of accounts. Assets represent everything a company owns that has economic value. Assets are divided into 2 main types: current assets and fixed assets. Current assets include cash, receivables, and inventory, which can be converted into cash or used within 1 year. Fixed assets include property, plant, and equipment used for the company's long-term operations. Normal balance of assets. The normal balance for asset accounts is a debit, meaning they increase when recorded on the debit side and decrease when recorded on the credit side. Liabilities. Liabilities are debts or obligations that a company must pay to third parties. Liabilities are also divided into 2 types: short-term liabilities, such as accounts payable; long-term liabilities, such as long-term bank loans. Normal balance of liabilities. The normal balance for liability accounts is a credit, meaning they increase when recorded on the credit side and decrease when recorded on the debit side. Owner's equity. Owner's equity refers to the owner's rights to the company's assets after deducting liabilities. It includes the capital invested by the owner and retained earnings. Normal balance of owner's equity. The normal balance for equity accounts is a credit, meaning they increase when recorded on the credit side and decrease when recorded on the debit side. Revenue. Revenue is the result of the company's operational activities, derived from the sale of goods or services. Revenue reflects an increase in the company's equity resulting from business activities. Normal balance of revenue. The normal balance for revenue accounts is a credit, meaning they increase when recorded on the credit side and decrease when recorded on the debit side. Expenses. Expenses are costs incurred by a company to carry out its operations, such as employee salaries, rent expenses, and other operational costs. Expenses reduce owner's equity. Normal balance of expenses. The normal balance for expense accounts is a debit, meaning they increase when recorded on the debit side and decrease when recorded on the credit side.